Red Cross to cut 2,900 jobs and slash 2026 budget amid global funding crisis. The EU warns Italy its use of golden powers to block bank takeovers may breach EU law. And the US removes 40% tariffs on Brazilian food imports, including coffee, cocoa, and beef. Hello there, welcome to the Qnews Economic Bulletin this evening, and we start off with the global economy, as the International Committee of the Red Cross will eliminate 2,900 jobs and cut its 2026 budget by 17% to 1.8 billion Swiss francs, as humanitarian organizations face unprecedented funding shortages. The reductions represent around 15% of the global humanitarian organization's workforce. The Geneva-based agency cited a shift in donor priorities toward defense spending and changing U.S. foreign aid policies under President Trump's America First approach. The ICRC President Marjana Spoljaric said the financial reality is forcing us to make difficult decisions, while vowing to maintain frontline operations in conflict zones. Meanwhile, European Central Bank President Christine Lagarde said the European Union could fully offset the impact of US trade tariffs by reducing internal trade barriers among member states. She argued that lowering EU internal barriers to match the Netherlands level could boost trade enough to counter American protectionism. Lagarde noted that achieving just a quarter of this reduction would be sufficient to offset US tariff impacts. Her comments come as the ECB has cut rates through 2024-25, with Lagarde pledging continued policy support while praising Germany's fiscal spending for buffering the economy.
Europe has become more vulnerable, also due to our blatant dependency on third countries for our security and for the supply of critical raw materials. Global shocks have intensified, with rising US tariffs, Russian aggression, and stiffening competition from China, to name a few. Our analysis shows that if all EU countries were to lower their internal barriers only to the level of that of the Netherlands, internal barriers could fall by about 8 percentage points for goods and 9 percentage points for services. I don't pretend that the Netherlands is the panacea for everything, but their barriers are significantly lower than most of the other EU members.
Christine Lagarde there. The European Commission has formally warned Italy that its use of golden powers to block banking takeovers may breach EU law. The move challenges Rome's extension of special veto rights, usually reserved for defense and telecoms, into the financial sector. The warning follows UniCredit's abandoned takeover bid for Banco BPM, which the bank blamed on government intervention. Italy's economy minister said Rome would respond to the EU's objections and draft clarifying legislation, highlighting the tension between national sovereignty and EU banking integration. And our first guest tonight is joining us from London. He is the CEO of QW Capital and is Gianluca Lobafalo. Thank you very much for being here with us on Q News, as always. So what aspects of Italy's golden powers does the European Commission believe may breach EU law? And could there be any serious consequences?
Yeah, regarding this, I mean, we have to clarify 2 points. Everybody is associating this warning to, as you said before, to the Unicredit BPM transaction, where basically Italy is exercising its golden power for limiting and forbidding basically Unicredit to take over BPM. But in reality, what Arianna Podesta, representing the Euro Commission, clarified yesterday was that this is a general revision of the golden power of Italy. It actually is going to be in line with the revision for the whole legal framework. Don't forget that there is another part that I think is much more relevant. That is the Article 21. The Article 21 specifically on merger in transactional merger within the European Union clarified that is sole responsibility of the European Union to exercise any exception to an international merge among companies belonging to different EU members. So that's remind me on another case of Unicredit where for some reason the German government is opposing to a takeover by Unicredit of Commerzbank. To me, that is much more problematic because in a way, if we want to see European Union as in one economic area of unity with eventually not just a monetary union, but as well a fiscal and political union, we cannot accept that a local government, in this case the German government, is opposing to a market-driven transaction. As it was not the case for Italy, never opposed when an Italian bank, in specific case, I can remind of BNL, was bought and taken over by BNP from France. So we have to be clear on this. To me, what is astonishing is not necessarily Unicredit versus BPM, is a technicalities on golden power. It will be resolved, I'm sure. But more concerning is that with the kind of no reason for opposition of the German government to the Unicredit takeover of Commerzbank. There is not any exception that is listed in the Article 21 that justify this. That is more concerning.
So is the European Commission pushing strongly for banking sector consolidation? And if so, why so?
Is not necessarily pushing for consolidation, is market. So not the European Commission, is market who is pushing for the consolidation. Bear in mind that a European bank, like an Asian bank, has to compete with US champion. We have seen a consolidation in the US that accelerated after the 2008 global financial crisis, and we have to be realistic. It's no longer a US domestic market, a European market. We are talking about a global market, even though now everybody's talking with globalization on the back foot, because of tariff. But in terms of financial market, this is a global market. So it's not the European Commission let's put it this way, is pushing for or is facilitating, but is seen as the only way for European bank to compete at the global stage. So the idea that there would be a country who is opposing this only because it's not their own banks who are taking over the other, frankly, is not justifiable. Don't forget what problem we had after the 2011 peripheral crisis was actually pure a Greek crisis that was developed in a peripheral crisis only because we had some weak player, specifically in Germany and in France, that were not allowing the final manifestation of market force with the proper implication on the Greek bond on the financial European market. So we cannot make this mistake again.
And can you explain to our viewers to what extent can Italy justify national interest interventions in the banking sector when it comes to EU law? Do they have a case there to put forward?
I mean, this is not national interest. I mean, the golden power on this specifically, we are not talking about any transnational operation because it's an Italian bank, Unicredit, who is taking over BPM. There will be internal equilibrium. There will be condition on no consolidation, too much consolidation within the national border. And that is something that is a technical issue that will be resolved. Again, I'm not seeing necessarily a specific warning on this specific deal, but is much more that the EU law will require more harmonization at any country level. Or regarding what we were saying before in terms of transaction, that is much more Unicredit with Commerzbank that I still don't understand how can be possibly opposed. There is not any exception can be underlined in this exception for the merger that can be supported by the German government, frankly.
So what message does UniCredit's withdrawal from its Banco BPM bid send about political risk in Italy's banking sector?
This is frankly is quite common. I mean, we are now talking about this transaction, but there are some banks, don't forget, they represent sometimes local interest, regional interest within a country. So the idea to have a dominant presence of a specific bank can be seen as a non-sustainable for the future of retail investor and savers. Italy has a specific economy based on small and mid-cap companies that are really linked to the regional, to the local economy. So the idea that eventually you want to see BPM representing more the local interest rather than the national bank is something that maybe the government is considering. I'm not aware of a specific position at the moment that justify that, but can very possibly be. And the Italian government has been extremely this Italian government has been particularly market friendly. So I would be surprised if they do something against market rule.
But
so it's to be seen.
But if Italy is forced to scale back its golden powers, would there be a particular impact, a big impact on its financial stability and the domestic banking competitiveness?
Not really. Don't forget that Italian bank system is one of the most resilient and definitely one of the most robust we have at the moment in Europe. Contrary to what the general assumption was, we had much more trouble, and we have seen in 2008 crisis in the UK banks that were extremely over leveraged. We had in German bank, and don't forget the trouble of Deutsche Bank, who had incredible loss in 2008 with the budget where that balance sheet was 4 times bigger than the German GDP. We know we don't have this systemic risk in Italy. Banks are pretty robust. Yes, they haven't been particularly leveraged. They've been criticized pre-2008 not to be extremely aggressive in terms of financial engineering, but that's pay off. Banca Intesa and Unicredit, who are the major Italian bank, are definitely in the top 3 of the most stable bank in Europe. So I don't see this as a risk for financial stability in Italy at all, nor for the credit system. It's a matter of balance or a connection between local bank and the local and regional economy. It's nothing to do with stability.
And does this dispute signal a deeper conflict between EU integration goals and the resurgence of national economic sovereignty in member states?
Not in the specific Unicredit BPM. You can argue that would be the case for Unicredit Commerzbank, yes, but we have to see. This is still an open matter, hasn't been resolved. I believe it will be resolved in a good way, in a way European leaders realize that we need to have, as we said before, a European champion. It doesn't matter if it's an Italian bank who overtake a German bank or a French bank overtaking an Italian bank. The interest is at a European level. We have to build very strong champion, market-driven. It shouldn't be a European Union political decision to trigger a consolidation. Should be market-driven, as it is the case nowadays.
Gianluca Lobofalo, thank you very much for joining us, CEO of QW Capital. Thank you very much indeed. Now back to our economic news, and still in Europe, where British retail sales fell 1.1% in October, marking the first monthly decline since May, and signalling weakening consumer spending ahead of Finance Minister Rachel Reeves's budget announcement next week. The drop was sharper than economists' forecasts of flat sales, and coincided with a decline in household confidence. The data adds pressure on Reeves, who faces higher than expected government borrowing and may need to raise 20 to 30 billion UK pounds in taxes. Consumer spending remains subdued, with savings rates elevated, reflecting ongoing economic uncertainty. Despite the downturn, some major retailers expressed optimism about Christmas trading prospects. Official data has revealed that Russia's annual inflation rate slowed to 7.7% in October, down from 8% in September. However, underlying price pressures continue to build, with core inflation, which excludes seasonal factors, accelerating to 7.1% year on year. The Central Bank of Russia reaffirmed it will maintain tight monetary policy until inflation returns to its 4% target, despite the slight moderation in headline inflation. Now to Asia, and the National Energy Administration has reported that China's electricity consumption, a key indicator of economic activity, grew 10.4% year-on-year in October to 857.2 billion kilowatt hours. The strong growth was led by a 23.9% surge in residential electricity use and a 17.1% increase in power consumption by the tertiary sector. Industrial electricity demand also rose 6.4%, indicating sustained manufacturing and production activity. Total power use for the first 10 months of 2024 reached approximately 8.62 trillion kilowatt hours, up 5.1% from the same period last year. Japan has approved a 21.3 trillion yen stimulus package, its largest since the pandemic, to support households and revive economic growth. The package includes energy subsidies, tax cuts and direct payments starting in January, alongside long-term investments in shipbuilding and defense. The move comes as Japan's economy contracts and inflation remains above the central bank's 2% target. While the government pledged fiscal responsibility, analysts warn the measures prioritize short-term relief over structural reforms needed to address persistent inflation and weak growth. Japan's core inflation rate remained at 3% in October, staying above the central bank's 2% target and keeping alive expectations of a near-term interest rate hike. The data matched market forecasts and showed underlying price pressures broadening. The figures come ahead of the Bank of Japan's December policy meeting, where officials will weigh persistent inflation against concerns about economic uncertainty, with two board members having recently dissented in favor of rate increases. The data reinforces expectations the Bank of Japan could soon raise rates above the current 0.5% level. Now to Africa, and Kenyan President William Ruto announced an ambitious plan to attract $38 billion in investments aimed at boosting infrastructure and workforce training. During his State of the Nation address, Ruto highlighted achievements under his administration, including controlled inflation, export growth and expanded digital access, as he works to reshape Kenya's economic narrative and attract foreign capital.
Donald John Trump, do solemnly swear that I will faithfully take office of President of the United States.
Capital open, the emergence and reciprocity.
Mexico. Canada. Greenland.
President Trump has lifted the 40% tariffs on Brazilian food imports, including beef, coffee and cocoa, reversing a policy that had contributed to rising U.S. grocery prices. The move, effective November 13th, follows similar recent tariff removals and comes amid declining approval ratings linked to food inflation. Brazil supplies about 1/3 of America's coffee and has become a key beef supplier. The decision is expected to quickly release Brazilian coffee stocks held in U.S. bonded warehouses and restore normal trade flows, with Brazilian industry groups welcoming the policy change. For his part, Brazilian President Luiz Inácio Lula da Silva has welcomed US President Donald Trump's decision to eliminate 40% tariffs on Brazilian food products, calling the move a positive step for trade relations. The tariffs imposed in July over Brazil's prosecution of former President Bolsonaro had affected key imports, including beef, coffee and cocoa. The removal follows similar recent US tariff reversals and comes as the White House addresses concerns about rising domestic food costs. The Congressional Budget Office estimates President Trump's tariffs will reduce U.S. deficits by $3 trillion if maintained through 2035, revising down its August forecast of $4 trillion. The nonpartisan agency's latest calculation reflects tariffs imposed between January and mid-November. The CBO now estimates primary deficits will fall by $2.5 trillion over 11 years, with government borrowing costs declining by approximately $500 billion. The revision comes as the Supreme Court reviews legal challenges to the tariffs, which critics argue ultimately burden American consumers with higher prices, while the administration touts them as a revenue windfall. Elsewhere, China has purchased nearly 1.6 million metric tons of U.S. soybeans this week, the largest weekly total since 2023, signaling a potential thaw in trade relations. The sales are part of a broader 12 million ton commitment announced by U.S. officials following the Trump-Xi meeting. The buying surge has boosted soybean prices nearly 12%, providing relief to American farmers. However, the rally has made U.S. supplies uncompetitive with Brazilian beans in other markets. While China has not formally confirmed the full purchase target, the move represents a significant shift after months of limited buying during trade tensions. Chinese Premier Li Qiang announced China's commitment to work with South Africa to secure zero tariff treatment for South African goods. This came in a meeting with President Cyril Ramaphosa during the G20 summit in Johannesburg. Li stated the two nations would collaborate to safeguard the multilateral trading system and ensure the policy is implemented swiftly. Now, New York Fed President John Williams has said the Federal Reserve can still cut interest rates in the near term, despite acknowledging that progress on inflation has temporarily stalled. Williams expects price pressures to ease as tariff impacts fade and the labor market softens. His comments come amid debate among Fed policymakers about whether to cut rates at the December meeting. Williams described current policy as modestly restrictive and sees room for adjustment toward neutral, contrasting with some officials who want clearer signs inflation is returning to the 2% target. Meanwhile, Federal Reserve Vice Chair Philip Jefferson said the current AI-driven stock surge is fundamentally different from the dot-com bubble, noting today's AI firms have solid earnings and less debt. While acknowledging that a shift in AI sentiment poses a risk, he emphasized the financial system remains sound and resilient. Jefferson cautioned the AI's economic impact may be bumpy, but sees limited systemic risk since the sector isn't heavily leveraged. He will monitor borrowing levels as AI infrastructure expands. To the world of tech then, and Google is making its final plea Friday to avoid a court-ordered breakup of its advertising technology business. The closing arguments come after a judge ruled the company holds illegal monopolies in digital advertising. The Justice Department wants Google to sell its ADX exchange to restore competition, while Google argues a breakup would harm customers. The case represents the biggest current threat to Google's core business operations. An appeal is expected regardless of the outcome, potentially extending the legal battle for years. Tesla CEO Elon Musk and Nvidia CEO Jensen Huang have announced partnerships with Saudi Arabian artificial intelligence startup Humane at the US-Saudi Investment Forum. They both confirmed that they are developing a 500-megawatt data center in Saudi Arabia. Huang remarked that it was extraordinary for a startup company with virtually no revenue to undertake such a massive project for Musk, describing the 500-megawatt data center as gigantic. He added that the company was off the charts. Huang also stated that Nvidia is collaborating with Saudi Arabia to build supercomputers capable of simulating quantum computers. So to the Middle East and North Africa, and the Central Bank of Egypt has held its benchmark interest rate at 21%, maintaining a tight monetary policy as inflation continues to pressure the economy. Annual headline inflation rose to 12.5% in October, driven by higher services and non-food prices. Despite economic growth improving to 5.2% in Q3 2025, the bank cited persistent inflation risks and global uncertainty for its decision. The bank expects inflation to peak near year-end before beginning a gradual decline, reaffirming its commitment to reach its 7% inflation target by late 2026. The United Arab Emirates has committed to invest up to $50 billion in Canada, establishing a sweeping new economic partnership focused on artificial intelligence, energy and mining sectors. The framework agreement was announced during Canadian Prime Minister Mark Carney's visit to Abu Dhabi today. At the Canada-UAE Investment Summit, Carney highlighted the strategic alignment between the two countries, noting that Canada is fast-tracking major projects to transform our economy, he says, and finding new partners in response to fundamental changes in U.S. trade policy. The investment will be channeled through UAE firms, including ADNOC's investment arm, XRG, and AI company G42. Official data has reported that Qatar's consumer prices increased 0.9% in October, pushing the annual inflation rate to 1.11%. The rise was driven by sharp increases in services and recreation costs, with miscellaneous goods and services jumping 4.76% and recreation costs rising 3.23%. Housing costs also contributed to the increase, rising 0.83%, while food and beverage prices provided some relief by falling 0.26%. Excluding housing costs, inflation showed slightly stronger monthly and annual growth. The G20 Financial Stability Board has warned that the rapid growth of private credit markets and stable coins needs close monitoring. FSB Chair Andrew Bailey called for stronger modernized financial regulations and highlighted the growing role of non-bank financial intermediaries as a key focus for next year. He also stressed the need for improved cross-border payments and robust frameworks for stablecoins, cryptocurrencies pegged to real-world assets, to ensure they operate safely. Bailey criticised major economies for failing to fully implement global banking standards, including Basel III. Bitcoin and Ether have plunged to their lowest levels in months on Friday amid a broad pullback from risk assets. Bitcoin fell 5.5% to $81,668,000, a 7-month low, while Ether dropped over 6% to $2,661,000. Hitting a 4-month low. The sell-off has wiped roughly $1.2 trillion from the total cryptocurrency market over 6 weeks, with both major tokens down around 12% for the week. The decline reflects fading expectations for US rate cuts and concerns over tech valuations, with Bitcoin having erased all its year-to-date gains. Before we go, just time to recap the main economic headlines this evening. The Red Cross to cut 2,900 jobs and slash 2026 budget amid global funding crisis. The EU warns Italy its use of golden powers to block bank takeovers may breach EU law. And US removes 40% tariffs on Brazilian food imports, including coffee, cocoa, and beef. Well, with the markets closed, the Economic Bulletin will take a small break over the weekend. We will be back on Monday, though. And don't forget, you can find news 24 hours a day on our social media platforms at Qnews EGY. Thanks for watching and have a lovely evening.